The banking sector delivered stellar performance for the third quarter of 22-23. However, problems have started to show. A look at the Nifty Bank Index would indicate this problem as well. Over the last week, the value of Nifty Bank Index has fallen 5% from 42,821.25 to 40,730.15. It has averaged over 40,000 levels since September from around 38,000 a year ago. The average value was just above 30,000 in the pre-pandemic period. The fall has come despite the fact that net profit for the industry has grown upwards of 30%. So why then are bank stocks falling? We talked to an expert to understand.
So, after a strong rally in the past year for the bank Nifty, the start of this year has not been the best for the banks. And there are several reasons for this. One, as you rightly mentioned, about the pressure on net interest margin. So now we need to understand that the fundamental reason why there is a pressure on net interest margin is because the deposit growth for the banks in the past couple of quarters has been lagging the credit growth. So the pressure on NIM, I believe, has just started and it could be more severe going forward. Secondly, what is happening because of the slowdown in deposit growth is that a lot of the banks, in order to increase their deposits, they're relying a lot on bulk deposits over retail deposits. So due to this, we have witnessed in Q3 that the CASA ratio of most of the banks have fallen. I believe the biggest fear for the market currently is that if the deposit growth fails to gain momentum going forward as well, the loan growth could come under question, and we don't want that to happen.
Another factor is that over the last year, credit growth has registered a stellar 16.5% increase, but deposit growth has lagged at 10.6% as per data available till January 13th. This credit deposit mismatch is forcing banks to raise deposit rates, putting pressure on their margins. The pickup in the deposits has already started happening. Deposit growth was 9.2% for the period until December 30. The other option for banks is to dilute their GSEC holdings and advance loan growth. But as government borrowing grows, even that may not be possible. Is the pain likely to continue in the coming quarters, and will banks see worse performance? Our expert answers.
Banks have seen the corporate deleveraging, and that was used to be kind of overhang in terms of the higher gross NPA and net NPA. And we have seen for across the banks, the gross NPA and net NPA has fallen. So therefore, we will see a lower provisioning, which is called a credit cost for banks, will come down. So there could be some pressure on the margins, the top line, but at the same time, we will see lower provisioning requirements, and therefore that will more than offset the kind of a pressure on the NII front.
The transition of deposit rates is slower than the transmission in loans. Media reports suggest that even though net profits for banks were high in the third quarter, the CASA ratio, or the current account saving accounts ratio, for most banks was a problem. This is something that needs to be addressed. As credit growth slows and deposit rates rise, there will be pressure on the net interest margins. Banks will need to be careful in their approach and look for other means.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.